The strategies and concepts discussed are for educational purposes only and do not represent specific investment, tax, or estate planning advice. Investing carries an inherent element of risk, and it is possible to lose principal and interest when investing in securities. No strategy can guarantee a profit or prevent a loss. The views expressed represent the personal opinions of the presenter or featured guests, not necessarily those of USA Financial or its affiliated subsidiaries. Any opinions or forecasting statements are subject to change at any time and without notice. John Cyndia is an investment advisor representative of, and advisory services are offered through USA Financial Securities Corporation, member FINRA SIPC, a registered investment advisor. Life Stages Advisory is not affiliated with USA Financial Securities. Life Stages Advisory, Dean or Remington, or any guest we have are not affiliated with USA Financial Securities. Welcome to episode 66 of WTF, Wealth, Tax, and Finances. I'm your host, John Cyndia, certified public accountant and personal financial specialist. I have Remington and Dean in here today.
Hello.
Hi, guys.
Howdy.
Hey.
How you doing?
Oh, let's see. You can tell it's Saturday morning, so everybody's got their liquid death. Oh, we can't even say that, can we?
Yeah,
whatever
we can.
it is.
Well, we like liquid death.
Not sponsored.
Just like how some people like the stock.
Yes, and I have my coffee. So anyway, we're going to give you a little bit of an update on a couple of things. We're going to talk a little bit about the tax situation, what it currently has. There's been some changes during tax season that we've had to address. And one of the first ones was the $10,200 exemption on unemployment benefits. And we sort of got caught up in the middle of that. We had some people coming in early that we didn't catch until they mentioned that. And then they came back and said, well, that's okay, we'll handle it. The IRS will handle it, right? And so we won't have to do the amendments. But with the individuals that came in, and they're still coming in for tax preparation, the first $10,200 of your unemployment benefits are not taxable. So if you had $18,000 in benefits, you'll be able to eliminate or exempt $10,200 and then just get taxed on the balance. If my math's right, that's $7,800. So that can make a substantial difference. And we're in Ohio, and we have been able to do merit filing separate for several years. And in the past few, we have gotten to the point where merit filing separate saves anywhere from $500 to maybe $1,500 to $2,000 because of the way the federal brackets and the state brackets line up. So by doing that, we may have to pay the same tax federally or maybe a little bit more, but we get a lot more back from the state of Ohio. So the other day I was doing a return and had some individuals that their total earnings were over $300,000, but the way that it was split up, that the male spouse had over $180,000 and the female spouse had about $120,000. The limitations are $150,000. Well, they had each about $8,000 of unemployment. So when we did a joint return, they were totally, there was no exemption on that because of their earnings were over $300,000, $150,000 each, okay? So because of that, their entire amounts of unemployment were being taxed. When I did the merit filing separate, as I do in a lot of the clients, I was able to find out that we were looking to save upwards of around $1,800 to $2,000 because the female spouse had a salary and income of less than $150,000. So because of that, we ended up saving them quite a bit of money. So I think one of the things out there is whether you're getting your taxes prepared or depending on what state you're in, that really didn't matter what state you were in, okay? That was a situation that was a federal deal, and because of that, Ohio is actually following that, so that's not an add back to Ohio. So anybody listening to this in Ohio will be able to figure that out and hopefully benefit from it. Go back and, if you haven't done it, go back and amend. So we were looking at, what that would do, and I told the client, they were obviously extremely happy about that, but I thought I'd pass that tidbit along to look at it from a married filing separate versus a joint type of return. Yeah.
So I've only been, paying taxes for a few years, not been working most of my life like a lot of people have. When you go to amend, do you have to pay anything? Is there a free way to amend your taxes, or does it just
not
depend?
If I do it? I'm going to charge you. No, you mean as far as from paying like the IRS to do it or something? Or
Yeah, like is there like a free way to amend your taxes? I'm just asking out.
We've got some clients we've talked to before that had done something on TurboTax and they screwed it up and they came in here because they were trying to do it on their own or some of these other tax programs. And then they come in and we go back 2 or 3 years and we amend them for them. We charge them. But you could, if you knew what you were doing, you could amend that on your own, with something that way.
Not that I'm dodging the IRS by any means, but
no. You just don't want to pay.
I'm just wondering, John.
You just don't want to pay me, is what
to amend your return. I already did that.
Yeah. And so, when you have the opportunity to do that, whether you're preparing taxes yourself or having someone do that, just sort of a tidbit to throw out there to you, because that was announced right in the middle of tax season that they were going to exempt that portion. The other thing currently that they're talking about, and I think they're going to start that fairly soon here, is the child tax credits. Last year they were $2,000. This year in 2021 they're going to be $3,000 if your child is under 6, and for over 6 till I believe it's right up to the 18. It's going to be 30. It's $3,600 for less than 6 and $3,000 for greater than 6 years old. So when you're looking at that, they're looking to not only have you wait, you won't have to wait till tax season, but they're going to start advancing those amounts monthly. So it could be $250 per child or $300 per child to actually get could be direct deposit, could be a check, whatever. Anyone that's eligible. So if you got several kids, that's going to be, quite a bit of money that they could be looking at.
Is there a cutoff for income limit?
I didn't see if they have a cutoff yet. For income.
Yeah. So I mean, if my parents made $300,000, are they going to be getting $200 or $300 checks a month? You know what I mean?
Don't know. I haven't looked at it that closely because it's not affecting me or many of my clients. We've got a few clients in there that are that's going to affect, but I'd have to look to see exactly what that was. I'm sure there's an income limit. I don't think there's a child limit. So if you've got 3 or 4 kids, prior to that, you could have had a limitation on how many kids you're going to get credits for. Depending on what it is, earned income credit, they only give you up to 3 kids, from that standpoint. But from the calculation, we've got one client that's only making about $50,000-$60,000. He's got 5 or 6 kids, so it's going to be a substantial amount of money.
Yeah. If you're getting $200 or $300, a month
per
for each
month,
kid, that's a good amount. That's a good chunk of change
from that standpoint. So I assume what it'll be is similar to what the stimulus payments were, that you don't claim those in as income. They're a tax credit because you have the child. They're just advancing it to you, from that standpoint. Rem, while you're on the computer, see if you can look at that. See if there is an income limitation for the advanced child tax credits on that. See, we have this in real time. We're checking this out.
Right here. The enhanced portion of the credit is available for single parents with annual incomes up to $75,000, heads of household earning up to $112,500, and joint filers making up to 150,000 a year.
Okay.
So I mean, that's a substantial amount of you know individuals across the United States. If you're joint filing up to 150, that's a decent chunk of change.
Oh yeah.
So
because
you're making under that.
Because if the household's making 150,000, and those limits seem to be the limits that they've got, that they also have
For the
been
stimulus
using for the
payments.
stimulus.
Yeah.
Because the initial stimulus was from 75 till I think it was close to 150, and then the other one was 150 to almost 250.
Right.
Then they turned around and said, okay, it's 75 to 85,000 and 150 to, I believe it was 160. Or no, 75 to 80, and then it was 150 to 160. That's what it was. So they compressed that quite a bit on this last one. But when you start looking at all the different combinations of the PPP, the first one, the second one, the third one, and they're talking about a fourth one. So, I haven't even heard what that one's going to look like yet, but, they're talking about that. But the 75, the 112.5 for head of household, and then the 150 for joint, that's been sort of consistent now that they've come out with that as far as these limitations for any of these credits and some of the income and stimulus payments. So if there's an individual or a single parent that's making up to 75 and has several kids, that's 75,000, nothing to sneeze at.
No,
you
by no means.
Got a couple of kids, because I think the poverty limit that they're usually talking about is somewhere around 40,000.
Yeah.
And then so if you're 50,000 and you have 2 or 3 kids, you're probably still into it, depending on how many people are in the household. But
yeah, I mean, I think that's a big help too. For anyone who's not making a whole lot of money, working their butts off, they got kids. It helps.
But if the family's making close to 150, and then they're going to turn around, they got 4 or 5 kids, and they can still pull that out. There's another 4 or 5 kids. You got another $12,000 to $15,000 coming in there. Assuming they're like over 6 years old or something. So, and that's going to be tax free because it's a credit. So it's sort of an advanced credit. So I guess it'll be interesting to see how that, works out against the when the return is done. Because now, if you've got, say, $10,000, you got $4,000 credit, you would have a $6,000 liability. If you turn around and add an $8,000 liability and get $12,000 worth of credits, it'd be interesting to see how that's going to work. But I think they're going to be refundable credits. So they're giving it to you up front. So I don't think you're going to be paying those back. They're going to make sure that, you're getting those and you're going to keep that money.
I would assume they would tell you right off the rip, but it's always hard to tell.
Yeah, and a lot of this stuff, they're just going off the seat of their pants and just, saying this is how we're going to do it. But
whatever, we'll figure it out later.
Yeah, and they've been pretty liberal with the new administration as far as, sending money out. So I don't really think there's going to be any clawback. So whatever you're getting up front, you're probably going to keep it, and they'll reconcile it through the tax return next year. Anybody that has not received a stimulus on the first or second go-round can file in their 2020 taxes and get that difference. So the first one was $1,200 per spouse and $500 for each child or other dependent. The second one was $600 for the parents and or the kids. And if you have received them on the tax return, then we're reporting that you did get those. They're not being taxed, but you have to just show that you did get them. If you didn't, we're just putting in zeros, and then it shows up as additional refund. Okay? So once that happens, you actually, it can go against tax liability, or it can increase your refund that you're already getting from that. And the other thing, what was it? We've had people that are still entitled. They have been incarcerated. They're in prison. They're still entitled to it. If someone, for this third one, if someone died this year, 2021, they are still eligible for the $1,400. Okay, now if they died last year, they can't get it. But we've had some people that died the first of the year and everything, and they're still eligible for that $1,400.
They just have to call in and collect.
I don't know if they have to, what that is.
John, what's the toll-free number? What's the toll-free number for the
I don't know.
Like, this is not sponsored by Liquid Death,
but it's probably
that is a Liquid Death.
Yeah, it's probably 1-800. Oh my God, here we go. But yes, that don't call in for that. I wouldn't want to take that call.
No, like what's the actual,
like, what happens with that?
What is the reasoning behind offering that to
dead
spouse?
people?
Yeah, spouses passed away. I mean, I understand, like, if your money's out there to get, it's to get. But if you passed away before that was even available to alive people, why? Mm-hmm. I don't understand.
They've got the cutoffs. If there is going to be a reconciliation, and they think about it and say, okay, well, we gave so much out to a bunch of dead people this year.
How much do you think they give out?
I don't know.
I'll look that up.
It'll, yeah, but I'm sure it's quite a bit, or it could be, because what they may do is reconcile it with next year's tax return. So when we're preparing 2021, they may say, hey, if you had someone that died prior to this date or after that date, and they did receive this, you're going to have to pay it back. But in all honesty, the way that they're throwing these trillions of dollars away, I don't think that would happen. I don't think they're going to.
I guess it would make sense though when they sign those bills in. It's probably X amount of dollar for X amount of population, mm-hmm. and it whatever happens. Those mm-hmm. people still deserve that money regardless.
Well, in the first two, if the individuals died in 19, prior to 20. Well, let me see. Take that back. If they died in 20, because 2019 was giving you the ability, 2018 and 19 was giving you the ability to try and get some of this stuff in 20. Then when you're doing 20, if you hadn't had your taxes done, it's going to give you the ability to do something in 21. So, because we've had people that had not filed returns for 1 or 2 years, and we were hurrying up and filing something. And then some of the people had amounts that we had to file because they made less money and they weren't eligible for it prior to that. Some of them retired. So all of a sudden we put in, they were making over $150,000, $200,000. Now they're retired making $75,000 for the household. Now they're eligible for those. So we hurried up and filed, got the money back. And, going forward, they're going to be okay. But we've had some just strange things, depending on when someone died. We had to look it up. We had people, like I say, that were in prison, incarcerated. They were still eligible. There wasn't much that was, denying anyone a payment from that standpoint. So the rules on it's pretty liberal. If you're pretty much breathing,
you're in,
and you're under a certain income level, you're going to get some money. Yeah, you're going to get some money. And it may not be fair all the way around, but, it's and then there was the kids that fell through the loophole that it was mainly saying if the kids are under 17, well, kids are 17 or 18, or they don't get anything because they're a dependent. Yeah, you didn't get anything. So now
the
all
first
of a sudden,
two.
Yeah,
I was pretty upset, and I had a lot of friends who were upset because that's the case for a lot of college students. Is
mm-hmm.
You're still dependent on someone's taxes, but you still pay taxes.
But your parents got got the thing, you didn't.
Yeah, so like in the case,
tell them to cut you a check.
Seriously, no. I
knew a handful of people that they were living out on their own. Their parents just claimed them and they mm-hmm. got screwed over. So is there no way out of that?
Well, the thing is, it's a timing between who files first.
Right.
So
that's why I told my mom, I said, I'm going to file first and
screw you guys up.
Do all the college stuff and get like a $7,000 tax return. What are you going to do about it? Probably kick me out. But yeah, that's just, I don't know. I thought that wasn't fair. Like a lot of a lot of college students, at least that I know, are also working.
Mm-hmm.
Might be a different story if you were a college student who was strictly just going to college. Then I understand you really don't need that. But if you're working, you're paying taxes, you should be in.
Well, see, the thing is that we've always requested that the parents bring in the kids' tax returns, because a lot of times they'll say, "Oh, they got a W-2 for $2,000, I'm going to do it." Well, that's not quite the way it works, because we want the return to see exactly which way it's going to go, because sometimes the parents are making too much money that they can't get benefit from the education credits.
Right.
So now we've thrown it back down to the kid. The parents are out maybe a $500 credit now, okay, because of the exemption that they would get for the credit, since we don't have exemptions anymore. So they would have the dependency credit for $500. That's what they lose. But the student then gets an immediate $1,000 refund on the refundable side, and if they've got anything else up to the $1,500 of which they normally don't have as far as tax liability, then they can get the full $2,500 off of the American Opportunity Credit. Then they could also, which we've had this year too, turn around and maybe get the $1,000. Maybe they had another $500 of tax liability, so they got $1,500 there. And then they turn around and they hadn't gotten either the stimulus payments. Now all of a sudden it's like, hey, I've got zero here. My parents are making too much to claim that. So we turn around and have the kid do it, and the kid gets the stimulus payments. So now all of a sudden they got like $3,000-4,000 coming back.
That was how mine was going to be. It was like would have got the 2 stimuluses that I missed out on.
Mm-hmm.
The American Opportunity.
The American Opportunity for education.
Yeah,
first 4 years.
Something else. I don't. It was like $5,500 I would have gotten back, and I was like freaking out. I was like,
yeah,
what am I gonna do?
Well, yeah, you've got a full-time job,
right,
and you're making, so you've got liability in there, tax liability. So once you start looking at it, you would have gotten the full $2,500 plus all the other stuff,
right, on top of my normal return, which was
exactly.
I don't even remember, close to $1,000 or something like that.
But they claimed you and messed you
Screws
up.
Screws it. They just take all my money.
Yeah.
How dare I live there and use all of their free items?
Get
Mom
free
and Dad,
food.
if you're listening. Thanks.
Yeah. Boot his butt out of the house. Yeah.
He's going to be living in the studio.
Yeah.
Hope you don't mind.
No. Paying rent. But that's the thing that, people say, oh, you should have had those taxes done. It's like, wait a minute. We've had some stuff this year that, we're looking at it for 45 minutes to an hour just trying to figure out a strategy, because I've worked it out 2 or 3 different ways, and then we start looking at it again and something else comes up and it's like, oh my God, let's look at this. So it can be, it can be taxing when you're preparing these things.
Boo. Boo.
Okay. All right.
The fans
Enough.
did not like that one.
Fans, yep. The peanut gallery didn't like it. Okay, never mind. Let's see what else I have here. So far, they're looking at increasing only the top tier of the 37% to go back to the 39.6% if you're making $400,000 or more. And that's still to be decided. That's what they're talking about, but whether that's going to get through is another matter. So I think as the year goes on, we'll be reporting on some of the new aspects of the tax law that could be coming into play. I don't think most of those, if they do happen, are going to be able to be retroactive or be retroactive. I think you'd probably have mass carnage on your hands. A lot of the times they didn't, probably, prior to the Trump administration, what they were doing is holding off of any tax situations until late December. And it would give you 2 weeks to make up your mind, and then they'd make them retro to January 1st of the year, which was hard for planning. So you had to sort of assume that it was going to happen and hope like hell that if they did talk about it, that it was going to be maintained. Luckily it was. We guessed properly in most of those cases. But I think if you go now to try and make some of these changes late in the year or even in mid-year, and make them retroactive to January 1st, it's going to impact too many people too much too soon. too harshly, I guess. So I don't see that happening. I think if they do anything this year, it will be effective the 1st of next year, 2022. They won't make that retroactive. It just would not be good politics on their point. So,
gotcha. I don't think I fit into the over 400,000.
Not yet. Not yet.
Yeah.
No.
If you bring me on as a partner,
yes,
I've got ideas.
I've got ideas prior to that. Yeah.
I can get this place booming.
Yeah.
It might be illegal.
Yes. Oh, geez.
If anyone's listening.
Cut that part. Yeah. Anyway, you had one quick question. It's sort of tax related, I guess, but you were saying something about a trust, a simple trust question on something.
Yeah. So if you were, just say like someone left you behind, I don't know, a certain amount of money.
Okay.
What is the best way to move that into another investment vehicle without necessarily paying any tax up front? Is it possible to do that?
Yeah, the way the trusts usually are set up, I'm assuming the individual received this or have this trust from someone else passing or passed on.
Yeah.
It was probably in a revocable trust, which basically states that that type of a revocable trust, and you can go and see some of this in previous episodes that we discussed briefly, would be in that person's name. So it'd be John Cindy Revocable Trust, could be John Cindy Revocable Family Trust, whatever. Anyway, what it is I transfer and put my, whether they're investments or bank accounts, we'll keep it simple, just bank accounts and investments that are in my name, I transfer those in and I put them in John Cindy Revocable Trust, and that's the new name of them. They work the same. I have access to them the same, everything, except when I pass, they go directly to the beneficiary that's listed in the trust document. If you're outside of that and you don't say payable on death or transfer on death, then it would have to go through probate, and that's where it starts to get expensive because the registration from the individual has to go over to the person that you stated in your will for that to go into. The trust allows for ease of transition and transfer without having to, it bypasses probate. You don't have to go through that. Now, that trust at that point in time could have been made into a permanent trust or a testamentary type trust or whatever, and become irrevocable at that point, and say it may have had terms like, upon my death, I don't want this person having anything but the income off of it. There's what they call 5 and 5, at 5% usually allows them to pull out some of the principal out of that, or for, health and welfare and things like that. It might state, give them $5,000 per quarter or semester for education assistance.
Could pretty much be anything.
Really. They can dictate whatever they want.
$5,000 for McDonald's fries.
It could be as
Can I do that?
As goofy as you think.
John, I'm leaving you a trust in my name.
Thank you. Yeah. I like McDonald's fries.
$5 a month for McDonald's fries.
Yes, that'll work.
And then you'll have to claim it on your taxes.
I like them with plenty of salt, too.
Oh, you're that guy.
I'm that guy, yeah.
At least you're not the guy that goes through the drive-thru line and wants no salt.
I walk through the drive-thru line? No, it wasn't me.
Yeah.
That was not me.
Ride your bicycle. Yeah. Now we digress.
But, yeah, that was Remington.
Yes.
Right.
My bad.
But the what you can do is pretty much dictate whatever you want. If you feel your beneficiaries are irresponsible, then you can make it such that they will never have control, and give them X dollars at a certain age, or achieving a certain goal, or doing whatever.
Would the beneficiary, would they know?
Well, upon the reading of the trust, they would, upon usually the reading of the will or the trust or whatever, then they would have that. There's a trustee in there that would turn around and work with the beneficiaries.
Because it always seems it's like people are like, I didn't even know.
Yeah, they don't.
That I was getting this when I turned 35 or when I got married or whatever. They didn't even know.
Yeah.
Which I always think is like crazy. Like, wow, I had $50,000 sitting in this trust fund and you didn't know you were going to get it.
Yeah. And that's not unusual. It's I had one of my first clients 35 years ago. His dad had a house that it should have probably been burnt down. I don't think it was even worth $40,000.
You were going to arson his house?
No, he was.
Oh, okay.
But his dad passed away and left him like $800,000. It was all in CDs.
Oh my gosh.
And he's like,
he had no idea what was happening?
No, his dad died in his house, and it was just like, what is he doing? He was like a hermit. And he had no idea he had that kind of money. And he left him about $800,000.
That's crazy.
Yeah, and he had no clue. So right after that, he said, that's not happening. So
Rem's laughing because you said CDs. And he's thinking of
I hope you're cutting
like
this.
disc CD, like compact discs. Michael Jackson's Bad. Something like that.
I kept picturing like he had it like tucked in, like those old like CD.
You're cutting this, right?
The stacks, like it's got the stick that you like put them all on. And you close.
Oh yeah.
I picture you put like 800,000 between each of the.
That's pretty funny.
No, I was
dumb. Funny.
I'm sitting here going, what the hell are they talking about? So yeah, you can cut that part. So what we were talking about? So he inherited the $800,000 in bank CDs, and he didn't even know that he had that kind of money. So we invested that for him right away. Put it in a trust. Yeah.
Wouldn't it be beneficial though? For if you're doing that to somebody, wouldn't it be beneficial to probably tell them? Is that an afterthought?
No, it's just the individual. We've had it to the point that some of them didn't want their kids to know anything, and they told me not to tell them.
I just think that's so crazy. I don't know. Maybe my family's a little more in tune with like my grandparents' finances, like a little more involved than some families are. Which I don't know. I don't know. I think a lot of people hide a lot of secrets behind finances, and
nobody wants to talk about that.
Nobody. It's all dangerous. It's dangerous thoughts to everyone. So I get it, but I don't know. Just the way I've been raised, I'm not like open. I don't tell everybody what I make. But,
but
I would share something like that with my children. That's all I would say.
If you're giving one of them more and the other gets X amount less,
then I wouldn't tell them.
That might be a reason why. Like if
John's getting a $5 a month McDonald's fry coupon, you're getting $10 a month.
Oh, that you said it was $5,000 lump sum.
Yeah.
No.
Oh, okay. So the thing is, the thing is that the parents dictate that, and sometimes they'll have a meeting, and other times they won't. They just said, "Hey, I'm setting this up. This is what we're going to do, and it's none of your business until something happens to me."
Why don't you give it to me now?
Well, that's the thing. We've had some that were 100 years old, so the inheriting kids haven't gotten anything yet, and they're in their 70s. Oh. So I mean, come on.
Yeah, it's like I can understand.
What are you gonna do? You want to buy a house?
Not really.
I've got 12 of them. I'm retired, and what else am I gonna do?
My back hurts really bad.
Yeah. So it's just we've seen all kinds of goofy stuff going on as population's gotten older, and when you start seeing an 80, 90-year-old person, you've got their kids are 60 and 70. You could have inherited some of that money at 40 and 50, but it's not going to help them at 70 and 80.
Yeah. I've got a guy that I work with who's going through that situation where his mother just passed away, and he's got 3 siblings, and he's the oldest, and he's mid to late 50s. Mm-hmm. And he came into work the other day, and he's like, I don't know what to do with all this. Like, we're splitting it evenly, but like, all my stuff's paid for. I'm just going to invest it, I guess.
It's certainly a little different, when you get into your older ages, typically, you kind of start to figure it out. Mm-hmm. Once you get into your like early, late 50s, like kind of you got a good savings. A lot of your stuff's starting to get paid off if you've, done everything the correct way in a sense. But yeah, I mean, I don't know. I don't know what I would do if someone was like, hey, you're getting $100,000, you're 60 years old. I don't know what to do with that. I'm going traveling. I don't know.
Yeah. Well, it runs the gamut. We've seen people that they don't have any money because they've never been able to manage it. And as soon as they get it,
they blow it.
They blow it right away. Other ones have it and they just turn around and, they put it in the savings, and guess what? They've never spent their first dollar. They're sure as hell not going to spend this next 100,000.
Now they're going to give $1.2 million to their kids when they pass away.
And they will make sure it goes right through everything in about 4 years. You know? So, yeah, if you're incompetent, you're incompetent for life. I don't think there's any way for you to get out of it because, you know,
Can't teach stupid.
stupid is what stupid does, I guess. And that's, yeah, if you're stupid, you're stupid. So,
Thanks, John.
yeah, that's it. Gomer over here. Anyway, whether that was insightful or not, you've got it. I hope you cut some of that other stuff out.
I got a few laughs at least.
Yeah.
We ran around.
Yeah.
It's all right. We made it back to where we belong.
Yes. So if you do have any other questions about taxes or any of the new potential laws coming up, or how to use some of the tax strategies in whether you're filing or planning taxes or anything like that, give us a yell at jcindia@lifestagesadvisory.com. Like us, love us, click the buttons, do all that stuff on YouTube.
I'm
what else
wondering
you're
when
supposed
you're
to
ever
do?
going to get it.
I don't know.
I'm just laughing over here because you said give us a yell. I'm picturing him typing in all caps at you.
Yell at me. Just whatever. Anyway.
John, I need to know about taxes.
So I hope you guys enjoy this. We'll talk to you soon. Thanks.